Good afternoon, everyone. Thanks so much for joining us today. My name is Stephanie Creedon, and I'll be your host for today's webinar, Revenue Recognition Part 2, Understanding Variable Consideration. Before I introduce today's presenters, I'd like to go over some housekeeping items. Today's presentation will last about 45 minutes, and then we'll have time for some questions. The slides can be downloaded at www.wolfandco.com/webinars/2018. You have two options for audio today. You may dial in by phone or listen through your computer. Our audience will be muted during the session, so if you have questions at any point, please send them in to me by using the questions box located on the webinar's control panel. We will be taking questions at the end of the presentation. I'd now like to give a brief background of the firm. Wolf & Company was established in 1911 and have 2 centuries of experience providing our clients with assurance, tax, business consulting, and risk management services. We have over 250 professionals working for the firm and have offices in Boston and Springfield, Massachusetts, Albany, New York, and Livingston, New Jersey. It's now my pleasure to introduce today's presenters, Scott Goodwin and Cecilia Ferret. Scott serves as a member of the firm and Technology Services Team Leader. Cecilia is an Audit Principal and Software Sector Leader. Thank you both for presenting today, and I'll now hand the presentation over to Scott to get started.
Thanks, Stephanie, and thank you all for joining us this morning. I think we've got a fair amount to get through, and I wouldn't be surprised if we had a lot of questions, so I think we'll jump right in. Before we get too far, I just want to tell people or remind people, if you were on the earlier session, these webinars are really designed very specifically for software companies, and even to the extent we can do it to SaaS companies. And the webinar is also, it's not sort of intro to 606. We are sort of presuming at least a basic understanding of 606 and the 5-step model. So we will be focused primarily on step 3, but we are going to jump quickly to step 4 because I think it's going to be our only chance to cover that. So here's the agenda we have for us. So Cecilia is going to introduce us to the idea of variable consideration and what you should look for to identify that. I'm going to talk to you about how to estimate that variable consideration. Cecilia is going to introduce you to the idea of significant financing components and how you might identify those. And then, as I mentioned, we are going to finish up by touching briefly on the step 4 process of allocating the transaction price, and then we'll wrap up with some Q&A.
All right, thank you, Scott. So before we kind of dive into steps 3 and 4, we wanted to just quickly highlight the 5-step model. As a reminder, 606 is a principles-based standard, and the FASB built 5 steps to help us all achieve that core principle. The key concept here is to recognize revenue in order to depict the transferring of promises for the right to receive consideration. So as Scott noted in this webinar, we are really focused in on steps 3 and 4 of the model, determining the transaction price and then allocating that transaction price to the identified performance obligation. The remaining webinars will discuss other aspects of the model. So jumping into step 3, the step requires that the entity determine the transaction price, which is defined as the consideration an entity expects to be entitled to receive for the transferred promised goods or services. So this excludes amounts collected on behalf of third parties, which an example of that would be sales tax. So this could be a very straightforward process for many companies. However, the complexity really comes in when the entity needs to consider the impact of variable consideration, of significant financing components, of non-cash components, which are at fair value, and consideration that is payable to the customer, which is generally treated as a reduction in the transaction price. So there are many items that could impact the ultimate consideration an entity expects to receive. Today we are focusing on variable consideration and financing components in step 3, which can be explicit or implicit based upon the historical business practices. An example of implicit would be a history of granting price concessions, and I'll have a bit more on that later. So what is variable consideration and when might it be present? So really any time that a future event could impact the transaction price, there could be variable consideration present. Consideration can vary because of a right of return, a discount, rebates, performance bonuses, etc. And when it is present in a sales arrangement, we are required to estimate the amount of consideration that we expect to be able to receive. Before I dive into the examples, I wanted to make one small point here. I added sales and usage here with an asterisk on the slide. This is because for software licenses that fall under the license of IP guidance, remember these are your on-premise licenses, you'll need to review the guidance within the license of IP subsection rather than regular variable consideration guidance. That's because there are special rules for sales and usage licenses which defer revenue recognition to the later of the sale or usage or when the performance obligation has been satisfied. This is, as a specific name, it's referred to as the royalty recognition constraint, which is different from the variable consideration guidance we are discussing in detail today. We'll touch more on this in our fourth webinar, but it's just something to be aware of. So now I'm going to move through a few examples of what is and what is not variable consideration, and then Scott's going to walk through the rules around estimating variable consideration. So scenario one. So the question here is, is each case an example of variable consideration or is it an option to purchase additional goods? Let's take case A. A customer purchases a 2-year subscription to a SaaS application for 500 users for $1 million. The contract states that the customer can add additional users during the 2-year period at a price of $800 per user per year. So here the entity would determine that its performance obligation is to provide continuous access to the SaaS application for the 500 users for the 2-year term. So the entity concludes that it has provided the customer with an option to purchase additional subscriptions for additional users because the entity is not obligated to provide access for the additional users until the customer makes the purchasing decision. So in case A, the $800 per user per year is an option to purchase additional subscriptions. It is not variable consideration. So contrast this with case B, where the customer enters a 1-year contract for a SaaS application that allows the customer to process payroll transactions. The customer agrees to pay an annual fee of $250,000 plus overage fees at a rate of 1 penny per transaction when it exceeds over 1 million transactions. A reasonable conclusion here is that the performance obligation is to provide continuous access to the SaaS application regardless of the number of transactions processed. The SaaS provider determines that the $250,000 annual fee is fixed consideration and all consideration received as overage fees is the variable consideration. So the difference between these two is that in case B, the entity is obligated to transfer the goods and services and the customer is obligated to pay for those goods and services at the outset of the contract, even if the consideration owed to the SaaS entity is not known at contract inception. So the next scenario covers a pattern of granting price concessions. So in this example, Sample Corp licenses a CRM software to its customers, typically on a 2 to 5 year term basis with coterminous PCS services that are paid annually. And Sample Corp is a relatively smaller player in the CRM software market, and therefore they have a significant incentive to try and ensure customers don't move on to larger CRM providers. As a result, Sample Corp has developed a practice of frequently providing its customers with a discount on its PCS fees in the final year. The discount has ranged anywhere from 30 to 50%. And is generally expressed to the customer as a reward for past loyalty. So Sample Corp concludes that it has a substantive history of providing these PCS fee discounts. Therefore, it's required to include an estimate of the future discount it expects to provide to its customers as a reduction of the transaction price at the outset of the arrangement. Now, this is likely a change from current guidance where price concessions were frequently recorded as conceded, so more of on a cash basis rather than at the outset of the arrangement. So now Scott is going to walk us through how we are required to estimate variable consideration.
Thanks, Cecilia. So yeah, just a quick reminder on where we are and what we're trying to accomplish in this determining the transaction price. So really, we're trying to figure out the total number of dollars that need to get allocated in step 4. So in step 2, we identified performance obligations. In this step, we're determining the transaction price. And then in step 4, we're going to allocate that transaction price to the performance obligations. And for the most part, that's going to be fairly straightforward until you introduce this concept of variability. And the first item to note is that variable consideration must be estimated at contract inception. And that's a fairly big change from the current revenue recognition rules. So this concept of fixed or determinable no longer exists. That was what got us out of having to estimate and record variable consideration previously. So this is going to be a bit of a whole new world. So 606 has prescribed 2 specific methods for making the estimate of variable consideration. The first is the expected value method, and the second is the most likely amount. And one thing to note here is that it is not an election. You cannot simply apply the one that is easiest or most readily apparent to you. You must select the method that you expect to better predict the amount of consideration to which you will ultimately be entitled. So let's look at each of those methods. So, excuse me, the expected value method is simply the sum of the probability weighted amounts in a range of possible consideration amounts. And this methodology would be appropriate when there are a large number of similar contracts with similar characteristics, which sounds really good until you ask me, what do I mean by a large number and what do I mean by similar? And the answer, probably not surprisingly, is that there's no hard and fast answer. It is going to be a facts and circumstances situation, but I think in many instances it's going to be clear. So for example, if you're a SaaS provider and substantially all of your customers execute the same contract, whether it's a click-through or whatever, and you deliver your solution in exactly the same way to all your customers, you're probably going to have a sufficient portfolio of data to allow you to use the expected value method to estimate variable consideration. On the other hand, if you're a software company where your customers may obtain a varying mix of products, so you're selling different types of software to different customers, or a varying mix of services with that software, or both, then you're probably not going to have sufficient information in order to apply the expected value method. Other things to keep in mind: the contracts don't have to be completely homogeneous. So just the elements that are actually creating the variability. So if you have one term in your contract that's creating variability, even if that term spans a couple of different contract types, as long as the attribute that's creating the variability is the same, then you may be able to apply the expected value method. So the most likely value method, it's the single most likely amount in a range of possible consideration amounts. So said another way, it's the single most likely outcome of the contract. This would be appropriate if there are a limited number of outcomes to your contract. So for example, if you had sort of a binary outcome, either you achieve a performance bonus or you do not. So a couple of other things before we move on. Cecilia highlighted that this is a principles-based standard, but for a principles-based standard, there are certainly a lot of things that you must do when you're estimating variable consideration. So the first one we've touched on, which is you must select the method that you expect to best predict the amount of consideration to which you'll be entitled. You also must select and apply one method consistently throughout the contract. And you must consider all information reasonably available. You must identify a reasonable number of consideration amounts. So what that means is if there are 1 million possible outcomes to the variability, you don't have to consider all of them, but you have to consider a reasonable number of them. And the expectation ultimately is that you're going to use the same type of information that you would use in a bidding process or in a price setting process. So what they don't want is for you to have a set of information that you use in the quote unquote real world. But when it comes to estimating variable consideration, you kind of throw up your hands and say, well, geez, I don't have any information around that. So that's the objective there. So it's important to note here, and we're going to go through a couple of examples that show this, that this estimation process for variable consideration is really a multi-step process. First, you would select and apply the appropriate method, the two methods we just outlined, but then you always have to consider the constraint guidance. Because the constraint guidance says that you must include in the transaction price variable consideration only to the extent that it is probable that a significant reversal in the cumulative revenue recognized will not occur when the uncertainty is ultimately resolved. So the interesting thing to note here is that this will, by definition and by design, result in a non-neutral estimate, which is something we don't typically see. Normally, we're always trying to come up with an unbiased estimate. We're using positive information and negative information and thinking about what reasonable people would conclude. But in this case, because revenue is so sensitive and so critical, the objective here is really to come up with a conservative estimate, and that is by definition non-neutral. And also, when you're assessing the probability of a significant reversal, you have to consider both the likelihood and the magnitude. So, for example, there may be a situation where it's very likely that there would be a change in the consideration, but that change is going to be very small. So a high likelihood, but a low magnitude. And similarly, there may be a very remote chance that there could be a change in the consideration, but the magnitude of that change could be material. So you need to consider both sides of that. So when you're looking at this constraint guidance, what kind of factors should you take into consideration? So first, how much of this consideration that's susceptible to variability is really outside your control? Is it something that is based on your activities or your customers' activities? How much experience do you have with contracts similar to this? What is the time until the uncertainty is resolved? Obviously, the longer the time, the higher the risk of a reversal. And then how likely are you, based on your past business practices, to offer a price concession or change in payment terms? Because that obviously introduces additional variability. So the last point to note here, which may not be obvious, is that you make this initial estimate, but then, like most other estimates, you have to re-estimate it and update that estimation each reporting period. Now, what you're thinking, I'm sure, is how do those changes in estimate get accounted for? And we're going to cover that in step 4. So let's look at a couple of scenarios here. So this scenario deals with a software company that offers a highly customized solution. There are penalties associated with delays in go live. So you've got a base price there of $500,000. Then there are 3 different penalty levels to which you could be subject. But then there's also a $100,000 upside bonus if you finish early. So a couple of other things that aren't explicit here, but we can assume there's only a single performance obligation that's satisfied over time. This is the delivery of the customized software. And then, I think you look at this and the expected value method is probably most pertinent. You have 5 discrete possible outcomes, so the expected value method is probably most appropriate. So what is that going to look like? So there are 5 different outcomes here, and we've assigned probabilities to each. And the probability weighted amount you can see there is 565,000. I think the math here is pretty self-explanatory. But a couple of things to note. First of all, once you've gone through this process and you've arrived at the 465,000, you're not done, because part 2 of this is always considering the constraint guidance. So how would you do that in this case? So probable, the term probable in the RevRec guidance is consistent with probable throughout the accounting standards. So it's generally considered to be 70 or 75% likelihood of happening. So if we start with the highest dollar value outcome, the $600,000, so that has a 15% chance, and we work our way down, the $500,000 outcome has a 50% chance, and the $400,000 outcome has a 20% chance. So cumulatively, you're at 85%. So what I can conclude is that there's an 85% likelihood that I will receive at least $400,000. So then I would say, okay, I look at that $400,000 and I would conclude that in comparison to the $465,000 probability weighted outcome, I wouldn't consider that to be a significant reversal. So the constraint and guidance would not have an impact on this situation. The other interesting thing to note, or interesting to me, I guess, is that the $465,000 is not actually one of the possible outcomes there. And how does that make sense? It makes sense because you'll remember you have to update the estimate every reporting period. So eventually you may start at $465,000, but eventually you will end up with one of those 5 revenue amounts. Okay. So scenario 4 deals with service level agreements, and I think these are fairly common. So in this case, you've got a 3-year SaaS. The customer pays a monthly fee of $1,000. If you don't meet the uptime commitment, there's a penalty, 10% on that month's fee. So we've got 2 different scenarios here. So in 4A, we've got a couple of additional facts. Sample company, in this case, has significant experience with contracts like this, and they rarely fail to meet the service level requirements and therefore rarely give credits based on their history. So how does the analysis go? If you need to decide what the most appropriate method for estimating variable consideration is, you'd probably decide it's the most likely method amount because they do have that very long history. I think they can say that the most likely amount is that they're going to get that $1,000. Next, since you have significant history, you're going to conclude that the most likely amount you're going to be entitled to is 100% of the monthly SaaS amount. And that part is pretty straightforward, but don't forget that you're not done at that point. You still need to consider the constraint guidance. So here you'd probably conclude that there's no impact from the constraint guidance, even if you incurred a penalty, which we think of that, if we think back to that probability and magnitude consideration, the probability here is pretty low, but even if you did have to incur a penalty, that 10% penalty would probably not constitute a significant reversal of revenue. So a slightly different scenario here in 4B. The facts here are you've only been in business a short time, so maybe you're an earlier stage company, and you have limited experience with contracts like this. So in this case, you couldn't conclude that it's probable that you're not going to have to issue credits. So again, you start with choosing the most appropriate method for estimating the variable consideration. In this case, you'd probably decide that the expected value method would make sense because you're probably going to have to assign a non-0% likelihood that you're going to pay some penalty. So in this case, we're not going to walk through any math, just a quick reminder that after you've selected the expected value method, you still will need to consider the constraint rules, and then you'd still need to reevaluate your estimate each reporting period. So I'm going to turn it back over to Cecilia to talk to us about significant financing components.
Okay, thank you, Scott. Yep. So significant financing components, if a contract includes a payment terms that differ from the timing of delivery of the goods and services, then the entity will need to evaluate if a significant financing component exists. The financing component need not be explicitly stated to be present, and 606 requires that the transaction price be adjusted for the time value of money if the timing of payments provide either the entity or its customer with a significant benefit. And I think it's important here to stress that the financing component could be for the benefit of the entity or its customer. Sometimes we think about more from the customer's perspective. So really here the objective is to recognize the amount that would have been paid in cash upon transfer of the good or service. The guidance does include a practical expedient to this rule. For contracts that are under 1 year, we will likely need not to adjust the transaction price for any financing component. Other exceptions may apply when the reason for the time between the payment and delivery exists for reasons other than financing. So customer prepays and controls delivery dates would be one. I'm going to walk through a couple examples in a moment. But really when I look at this, the first question that comes to my mind when considering this rule is how do we define significant? Well, significance is going to be analyzed at the contract level, and you must consider the difference between the promised consideration and the cash selling price, the length of time between the payment and delivery, and current interest rates. So now we'll go to some examples of exceptions to significant financing requirements for software companies. Some examples might look like this. So consider scenario 5, where there is a flexible arrangement where the customer pays the entity a fixed amount upfront, and then the customer draws down against this prepaid amount. So it issues purchase orders to acquire various software licenses and related services, and it's done at its discretion over the term of the arrangement. So in this scenario, the customer is controlling the timing of the transfer of goods and services, and therefore this does not qualify as a significant financing component. So let's contrast that with the second scenario where the software license is transferred to the customer at contract inception, and the customer will embed it in its products, and the consideration for the software license is a sales-based royalty. So in this scenario, the consideration is variable and it's outside the control of the customer or the entity. So this is also not considered a financing component. So now we're going to look at an example of a financing component. Scenario 7. So in this example, a SaaS company signs a 3-year deal, non-cancelable agreement with a customer to provide SaaS. The customer may elect to pay either $200 per month for total cash payments of $6,000 or $5,000 at the beginning of the contract term with no additional monthly payments. So if we think about this for a moment, the customer can pay as they use the SaaS application, or they can pay upfront. Paying upfront provides the customer with a discount of $1,000 and the SaaS company with the funds well in advance of providing access to its SaaS platform. Under 606, the difference in pricing together with the timing difference between when the customer will pay and receive the services indicates that the contractual payment terms under option B have the primary purpose of providing the SaaS company with financing. So the SaaS company will need to determine if the financing component is significant. Because of the difference between the cash selling price of $6,000 and the financed amount of $5,000 is about $1,000, and it's 20% of the financed amount, the SaaS company would conclude that the financing is significant. Therefore, an adjustment to reflect the time value of money will be needed if the customer elects option B at the beginning of the contract. The SaaS company will then evaluate whether the implied discount rate is consistent with the market rate of interest for companies with the same credit rating as its own. So assuming that it is the same rate, the SaaS company would recognize cash basis revenue of $6,000 and interest expense of $1,000 over the contract term as the performance obligation is satisfied. So now that takes us to step 4, allocating the transaction price.
Great. Yeah, so we have now leapt from step 3 to step 4. So to help us do that, just a quick refresher on what we're trying to accomplish here. So step 4 is allocating the transaction price. So we are allocating the transaction price as determined in step 3, including any variable consideration, to the performance obligations that we identified in step 2. And I have listed here the objective when allocating the transaction price. And I think it's important to read it just because it is referenced multiple times further down in the guidance when making some other decisions. So the objective when allocating the transaction price is for an entity to allocate the transaction price to each performance obligation or distinct good or service in an amount that depicts the amount of consideration to which the entity expects to be entitled in exchange for transferring the promised goods or services. So, I mean, it's really indicating that the allocation should reflect the substance of the business transaction. What value will you, the vendor, be entitled to for satisfying the performance obligations that you have to that customer? So we're going to cover three specific aspects of this process. So the concept of standalone selling price, which is pretty critical. What is it? How is it estimated? How is variable consideration handled in the allocation process? And then how are changes in the transaction price handled? Oops. Okay. We're good. So the definition of standalone selling price. So it's the price at which an entity would sell a promised good or service separately to a customer. The best estimate for standalone selling price is the price at which you actually sell it. When you sell that good or service separately, this is also referred to as the observable price. And when there's no directly observable price, you have to estimate what the standalone selling price is. There are three methodologies that 606 introduces here. Unlike the methodologies for estimating variable consideration, these are not prescriptive. You may consider these, but you're not limited to these. I think that the expectation would be that you would at least consider these options, but there may be others as well. So what are these three suggested methods? The first is the adjusted market method. So you look at the market in which the goods or services are sold and estimate what a customer would be theoretically willing to pay. And you might do this by looking at what your competitors are selling, what you might be selling a similar but somewhat different product for. So this is really trying to get market data and apply it to your particular good or service. The second is the expected cost plus a margin method. This is just as the name implies, you would do a cost buildup analysis and then apply an appropriate margin. You know, I think in a software case that might be difficult since the costs are hard to assign to a particular good or service. And then finally, the residual approach. So if you have observable standalone selling prices for all your other performance obligations, then you can assign the residual to the remaining performance obligation. So that case may be not likely, but it is certainly out there. The other thing to note is that you may need to consider more than one approach. So if you don't have particularly strong market data, you may look to a cost plus margin analysis to support that. It just depends on your situation. So let's look at a couple scenarios. So in this scenario, we have a SaaS company that sells a one-year subscription and they've got implementation services. So a pretty straightforward example. These are the only performance obligations, so 2 performance obligations. And the dollar amounts you have there are the contract price. So those are the amounts that you have put into the contract with your customer. So you can see them there. The total is $255,000. So a couple of more facts about this situation. You have sufficient history with contracts like this to establish a fairly narrow range of observable prices for both of the SaaS and the implementation services. You've made a policy election to use the midpoint in those ranges if a contract price happens to fall outside of that narrow range that you've established. So I've given you some ranges there, both for the one-year SaaS and the implementation services. So the question is, how would you go about allocating the transaction price of $255,000 to the 2 performance obligations? So just to note here that both the SaaS and the implementation, the contract prices do fall outside the previously established narrow ranges. The $225,000 SaaS is below, I think, the bottom end of the range of 230, and the implementation services at 30 in the contract are slightly above the top end of the range, which I think was 25. So in accordance with your policy election, the amounts in the standalone selling price column there are the midpoints in those ranges. And those would be the amounts that you would use to allocate the $255,000 to the two different performance obligations. So you see it ends up being a 91% and 9% allocation, and the total price allocation gets you back to the $255,000. So what are the lessons from this? So a couple of things. First of all, if you can establish a narrow range of observable prices, you can use the contract price as your standalone selling price. This is almost like the VSOE concept. You know, if you established VSOE by having a pattern of selling the same good in a pretty narrow range, then that price was good. Similarly, in this case, if you have that narrow range and the contract price were to fall within that range, no allocation process is necessary. You can simply take the contract price. And then how you handle contract prices that fall outside that range is a policy election. It simply needs to be consistently applied. You could just as easily have elected a different policy. So, for example, you could have chosen a policy where you chose the end of the range closest to the contract price as opposed to the midpoint. Simply a policy election. Okay, so allocating variable consideration. So you remember in step 3, we talked about how you estimate variable consideration. In step 4, there are provisions for allocating variable consideration that are slightly different. So if you think about how variable consideration might arise in a contract, it's easy to envision a scenario where the variable consideration is really tied to a single performance obligation. So the guidance does allow what I'll call sort of a specific allocation for that variable consideration. So the variable consideration can be attributable either to the entire contract and all the performance obligations therein, or to specified parts of the contract. That could be one or more performance obligations, or it could be one or more of the distinct goods or services in a series of distinct goods or services that form a performance obligation. But in order to do that sort of special allocation of the variable consideration to specific performance obligations or distinct goods or services, you have to meet specific criteria, and you must meet both of these criteria. So the first criteria is that the variable payment relates directly to your efforts to satisfy that performance obligation or transfer the good or service. And the second criteria is that by doing this, you would end up with an allocation that is consistent with the overall allocation objective. And you'll remember that I read to you the allocation objective, and this is one of those situations where the guidance further on refers back to it. So they ultimately want to make sure you end up with an answer that is not contrary to the overriding allocation objective when you're doing a quote-unquote special allocation for variable consideration. So changes in the transaction price. So how would a change in the transaction price come about? Well, you'll recall when we were talking about variable considerations, I reminded you that estimate of variable consideration would need to be updated each reporting period. So that is one element of change that could take place, but certainly not the only one. So basically, changes in transaction price are allocated to the performance obligations on the same basis as was done at contract inception. So if you think back to my example where you ended up with a 91% allocation to the SaaS and a 9% allocation to the implementation services, if for some reason there was a change in the transaction price, that change would also be allocated 91% to the SaaS performance obligation and 9% to the implementation services performance obligation. So what happens if I've already satisfied one of the performance obligations? So for example, if I have already performed the implementation services, then there would be an immediate recognition of that amount of the consideration, and that could be either an increase or a decrease to current period revenue. And if you had done one of those special allocations of variable consideration to a specific performance obligation, you would do the exact same thing here if the transaction price changed. The only other thing that I'll highlight here is that contract modifications and the related changes in transaction price are treated somewhat differently. So we're not covering that here, but just be aware that contract modifications is sort of a topic unto itself. So I think that brings us to our formal conclusion. Have we any questions?
We do have a few questions that came in. The first one is, what about reimbursable expenses? Is that variable consideration?
Okay, I guess I'll take that one. So variable consideration, the guidance is actually a little bit different than it is now. So the first thing you need to ask yourself is whether the costs that are being incurred are actually costs, fulfillment costs of you, the vendor, to actually satisfy your performance obligations to the customer, or are you simply reimbursing the customer for third-party costs that customer may have incurred? And you may sort of see where this is going in that 606 piggybacks off the gross versus net guidance to determine the treatment of out-of-pocket or reimbursable expenses. So if these are costs to fulfill, then they would be in revenue, and if you were simply reimbursing the customer for third-party costs, then they're probably not going to go into revenue. The current guidance requires that out-of-pocket costs be included in revenue. That same guidance doesn't exist here. As I said, it kind of leverages off the gross versus net. But I think you're going to end up getting to the same place as you would in terms of when things get into revenue and when things end up somewhere else. The big difference, I think, is going to be in the timing, because to answer the ultimate question, which is, are they variable considerations? Sadly, the answer is yes, if they're fulfillment costs. So that means for out-of-pocket expenses that are fulfillment costs and therefore going into revenue, they are definitely variable consideration. So you'd have to go through that same variable consideration estimation process that we just talked you through to estimate them. So the impact of that would be potentially a change to the timing of when you would recognize those out-of-pockets or reimbursable expenses. Hopefully that answered the question.
Thanks, Scott. The next question we got is, how could cancellation rights or refund rights impact a SaaS contract?
Okay, I'll take that one. So cancellation rights, I think that falls more in the area of performance obligations and some of the discussions we had in the first webinar. When I think of cancellation rights, I think, how long is the actual term of the SaaS contract? If there are rights to cancel, if it's a multi-year SaaS contract, for example, and there are rights to cancel after the first year, do you really have essentially a one-year SaaS contract rather than a multi-year contract? So I think cancellation rights are less, variable consideration and less impacting the transaction price and more of a performance obligation question. But certainly refund rights are variable consideration and would need to be estimated using the process that Scott outlined today.
Great, thanks. And we had one more question come in. What if I have more than one variable item in a contract? Do you have to use the same estimation method?
Okay, so that's a situation where you've got a single contract but more than one variable element. I think the answer to that is no. You're probably thinking back to the two estimation methodologies that I outlined and told you very specifically that you must choose the one that best represents. But that rule really applies at the variability element level, so the level at which the variability occurs, and not necessarily at the contract level. So it's possible that you could have a contract that has 2 or 3 elements of variability, and I would say you would need to select the method for each element of variability that best predicts what you are ultimately going to be able to receive for that. But I would say that if you look across contracts that have the same element of variability in them, I would expect to see the same method being used, with one caveat, and I'll go back to the overriding principle that you always have to allocate the amount that's most predictive of the amounts that you're expected to be entitled to. So given specific situations in a customer contract or in a specific customer situation, it may require a change in the methodology for estimating it.
Thanks, Scott. And thanks, Cecilia, for presenting on this topic. It looks like we did not have any additional questions come in. So if you do happen to have any questions following the conclusion of this webinar, please reach out to Scott or Cecilia directly. Their contact information is listed on the current slide. And copies of today's presentation are available at www.wolfandco.com/webinars/2018. I will also be posting a recording of this presentation to the same web address later on today. And as a reminder, this webinar is part of a 4-session series. Part 3 will be taking place on Tuesday, June 5th at 10 a.m. on the topic of cost to acquire and cost to fulfill. Immediately following the conclusion of this webinar, you'll have the opportunity to complete a survey. As always, we appreciate your feedback so that we can continue to improve our webinar program. Thanks so much for attending today, and we look forward to your participation in future webinars. Have a great afternoon, everyone. Great morning.